I'm Star Markworth. I'm the Loss Control Manager at Miami Valley Risk Management. We are a training partner today with the Miami Valley Communications Council, so our two organizations are working together to sponsor the program. Many of you here today are also members of Miami Valley Risk Management Association. We provide property and liability insurance for cities, and a lot of what I do is training and outreach to our cities, giving them training, policy review, those kind of things. So this training today hopefully will help get a lot of your answers answered and give you a lot of good knowledge moving forward. And I do have the privilege of announcing our next speaker, and he is the fearless leader of Maverma, Judy. Tom is the executive director at Miami Valley Risk Management. Previously, Tom was both finance director and assistant city manager at the city of Sydney, and also a brief stint as acting city manager at Sydney. He's a CPA. Don't hold that against him. He's not as boring as most CPAs, so he'll be okay. And don't be easy on him, because he has the topic of the finance part, and you only can do so much to make that exciting. But I think that you're going to find this is a great information for you. As Mark talked about, a lot of what you do, the biggest task that you have is that budget document and how that all works and how the different accounts. Tom's going to give you some good information to let you be a little bit more educated on how that all works. So I will turn it over to Tom.
All right, well, thank you, Star. Everything you need to know about government finance in 45 minutes is an ambitious schedule. So what we'll do today is we will move quickly through some of the slides, and we'll try to discuss some of the general topics and maybe leave you with some food for thought. And if anything we talk about today triggers any interest in something you'd like to explore further, feel free to contact me after this session. But let's move ahead. The environment we work in government colors what we do, our financial activities, our financial reporting. A for-profit private sector business exists for the purpose of providing a return to the owners, shareholders, investors. And it's maybe a slight oversimplification to say, but still true, that you can measure the success of a private for-profit with the bottom line on an income statement. In the end, that's where the profit or the success is measured. You can't say that about a government entity. You can't look at a financial statement and determine how successful you have been. So the focus in government finance and reporting has shifted to a different outlook, and that is one in which we try to demonstrate our stewardship. We demonstrate our fiscal accountability. We try to demonstrate that we are in compliance with the many rules and guidelines that come. We receive money from a lot of different sources, and it comes with strings attached. And we have to, in the end, be able to show that we have complied with all of those requirements that are put upon us. One of the outgrowths of that is fund accounting. And I look at a full-service government, and most of the cities here, I would say, are full-service city governments. I look at almost like a holding company, because at any one time, we're doing activities that are so diverse. At any one time, you could be arresting the bad guy over here, saving the heart attack victim here, providing recreational services to the children here, providing safe water and sanitary sewer there. It is so diverse that it does not make sense to throw everything into one bucket. And so fund accounting over time was the answer to that, which is just simply a separate set of books for different activities. And often we set up funds to account for the expenses of a particular activity. Oftentimes we are required to set up a separate fund by the entity that gave us money. We're required to set up a separate fund just to demonstrate that we've complied with their wishes for the uses of those funds. We're going to skip that one. And we'll move to the annual budget. And I was glad to hear Mark say earlier that the annual budget is, in his mind, the most important work product that they do. I have a generic definition of the budget on the screen, and I won't read the slides too often, but I will read this, where it says an itemized summary of estimated or intended expenditures to carry out the organization's stated purposes, underlined stated purposes, along with the proposals to finance them. And the reason I draw your attention to that is it's not columns and rows of numbers. The budget is really your financial plan to accomplish the objectives that you have determined as an organization you want to accomplish. Those objectives, those priorities that you've set, are the foundation upon which a budget document is built. And rather than starting a budget document with your fiscal officer with their green visor sitting in a corner putting numbers on a piece of paper, I favor starting a budget process with a review of what you want to accomplish next year. We all have plans and planning processes of some sort. I assume most of your communities have a comprehensive plan for your community, which hopefully often does, but hopefully isn't sitting gathering dust somewhere, because it is a document that was a lot of thought went into that document. And so that's a great place to start, very broad. And when you're thinking forward to your next budget, a review of that document to say, what do we need to do next year to move the ball forward on those comp plan objectives, is a great place to start. Hopefully, as a legislative body, you have other processes to do planning, perhaps an annual retreat for goal setting, perhaps you have some citizen forum events to get their input. But all of those things put together, hopefully, are helping you achieve a list, a menu of things that we need to accomplish in the next year to move the ball forward. That is where a budget needs to start. And then the numbers just flow from that. What do we need to do to accomplish those objectives? So it's very much a planning document. And I'll draw your attention to the last bullet on this slide, where it says it reflects public input, which again could be done through some sort of a forum, direct forum with the public, or perhaps you, as the elected officials, are your wishes are reflecting public input. But one way or another, it needs to reflect public input. But it's also the budget is also a communication device to communicate back to the public your priorities. Sometimes a budget document, though, is the very thick document that is intimidating when folks come in and they say I'd like to learn more about city finance, and you hand them this big document. That could be very intimidating. So ideally, a good budget document is one that has not just the rows and charts of numbers, because many people that doesn't register with them. But the ideal budget document is one that relies just as much on narrative descriptions and commentaries, charts, graphs, because people just they learn and they absorb data in different ways. And so ideally, that is what your document would look like. Sometimes I favor, if you have that large, intimidating document, having a budget in brief document that pulls out some of the overview financial data, supplements it with those things, the narratives, the commentaries, the charts, the graphs, and maybe in 10, 12, 15 pages, you have some nice document that if a person comes in and says, hey, I'd like to get more involved in your city, can you help me to understand your priorities and where the money's coming from and where it's going? And that's a great thing to pull out and to hand to them. But remember, it is a communication device. Okay, a question. What's a balanced budget? I don't know how much you've thought through that question. There are varying definitions of that. And the most simple one is this one, which is that our revenue for the budget year, our revenue will exceed or be equal to our expense. Does that sound like a good definition? It's common. And then there's the second one here that says, well, our revenue plus our beginning of the year fund balances have to meet or exceed our expenses. So in the first bullet, if you anticipate your general fund to have $1 million of revenue next year, that's the limit. That's your appropriation limit. You cannot appropriate for expenditures any more than that $1,000. And I apologize if you can't see that in the back of the room. Or that $1 million would be your limit. Under the second one, let's assume you expect to go into the year with a beginning of the year fund balance of $250,000. You still expect to take in $1 million of revenue. You add those together, your resources are $1,250,000. Under the second one, if you appropriate $1,250,000 or less to spend, you can say, hey, I have a balanced budget. So between the two of them, who would pick the first one? And who would pick the second one? And who's not sure? Between the two of them, I'd pick the first one, but they both have problems. There are issues with both of them. And the issue on the first one is, if that's your definition of a balanced budget, and you're committed to having a balanced budget every year, your fund balance only goes up. It only goes up. And the citizens, after a while, look unfavorably upon us accumulating cash resources. And that definition has become a stumbling block in some communities, because there are some times where you do need to dip into the fund balance. You are strong enough financially to do that, but there are, I have heard of, never in the cities where I worked. I have a former council person in the audience, where the council people will beat the desk and say, nope, that's not a balanced budget, I'm not going to do it. Okay? The problem with number two is you could spend every dollar you have and declare success and say we had a balanced budget. So I would offer a third option, and it starts off looking like the second option, and it says that we will look at our current revenue plus our beginning fund balance, the $1,250,000, but we're going to have a policy that defines a minimum fund balance. And this requires some upfront work for you. This requires you as an organization to thoughtfully consider the minimum amount of fund balance that you need to keep on hand to have in the event or to use as a hedge against unforeseen circumstances. Okay? We do that in our own financial budgets. The financial planners will tell you should have three months worth of expenses in the bank. In case you lose your job, you need a new roof, there's an illness in the family. Same principle applies in government. So that requires a process to thoughtfully consider what that is. So let's say you've gone through that process now, and you, working with your staff, have come to the conclusion that you want a policy that says we will not pass any budget that doesn't leave a fund balance of at least 20% of our annual revenues. So in this case, 20% of $1 million is $200,000. So we go to our board here. And we say, okay, our resources were $1,250,000, but we're setting aside that $200,000. So that leaves us with $1,050,000 that we can appropriate for expenditure next year. Now, I've oversimplified that process, but that concept is very important. That particular policy is the most important policy that you can have, and you apply that on a fund-by-fund basis. Those targets will be different depending on the nature of the fund. Most important policy that your organization can develop. And I think that particular model does address some of the weaknesses that we discussed in the first two definitions. The budget cycle, this is just a generic budget cycle, noting again that the review of the organization's objectives is the first activity in the process. The typical government in Ohio, income tax is your largest source of revenue in the general fund, runs anywhere from 60 to 65% for the typical city government. The revenue sources on the screen here, many of these revenue sources are beyond the control of City Council. Even the income tax, once you get past a rate greater than 1%, you have to go to the voters to get their approval to have a rate greater than 1%. Property tax is generally at the discretion of the voters. Income tax, even if you get it, you're at the mercy of the general economic conditions. A number of the items there are you're at the mercy of another government who's passing money down to you. The interest income, you're subject to just the general market influence and forces. So, and the revenues that you see here are to a large extent general fund revenues. Because they're beyond your control, that, in my mind, leads us to being conservative as we can, as is practical, on the expenditure side, because that's what you can control. Because you will see great fluctuations in these particular revenue sources. This next list tends to be a little more skewed toward the utility funds, but generally what you see on the screen there are fees and charges that you do have a lot of control over, and they're a lot more predictable. Most of what you see on the board there, you can approve, you can enact, and you can adjust through an ordinance of council. So, for instance, the water fund, if you have a water utility, you can control that much more than you can control your income tax revenue. And it's much, much easier to budget for a water fund or a utility than a general fund. Yes, ma'am. The question was whether a user fee would include a lodging tax. That is something that you have ability to enact at the council level.
We do.
Yes, and
Do you have to go to the county?
there is a process of where the county can get in and take some of that ability to tax. So there is some where you're stepping on each other's toes a little bit. And it's best to get in first if you're the city. But yes, that is something that you can control. And one thing about that, it's something we'll touch on briefly in a moment. The good thing about a lodging tax is that it's largely paid by non-residents.
Right.
So these are just some things that you'll have philosophical questions to deal with at times when you're thinking about how to finance your government. The question about income tax or property tax, which is the most equitable, we could spend a lot of time talking about that. Residents or non-residents, we just touched on that. Mark Schwederman, in the first session, I heard him mention about that how they provide citizen benefits, if you will, to those non-citizens who come in and work in their community. I think that's a wonderful policy. But it doesn't sound good to say, but from the finance guy's perspective, I am all about maximizing the revenue that we can receive from non-residents, because we're here to represent the citizens of this community, and there are some opportunities to do it. Income tax is a great way to do that, because they're paying the same rate as our citizens, and there is the argument: is it fair? Is it not fair to tax the non-residents? I think we can make a good case or a rationalization that it is. The employed versus retired. I don't have much to say other than if you have a ballot measure, an income tax ballot measure, go talk to your seniors, because most of their income is exempt and they're very community-minded, and they're a great group to get on your side if you're going to have an income tax measure on the ballot. In Ohio, there is a statutory system to build in safeguards to make sure that you don't overspend. The first one is that your fiscal officer will, before each year, prepare documents that go to the county budget commission that say, on a fund-by-fund basis, what is the beginning of the year fund balance going to be? In this example, it would be $250,000. What's the revenue we expect to take in this case, $1 million. And the county budget commission then will turn back to you something called an official certificate of estimated resources, saying that you may appropriate for this general fund no more than $1,250,000. That is a legal maximum that you may appropriate. We'll talk a little bit more, if we have time, about encumbrances. Well, let's talk about it now. when a budget is approved, and then later your city wants to enter into a contract for services or goods, the revised code says that before you can place that order, before you can enter into that contract, the first thing that your fiscal officer has to do is to certify that A, the appropriations exist for that expenditure, B, the money is in the bank or it's going to be collected soon, and C, that those appropriations haven't already been obligated to something else. And that language will appear, generally it's done through a purchase order. That certification language will appear on the purchase order. And when your fiscal officer signs off on that, they have made that certification that says, look, the money's there, the appropriations are there, all is good. And then they will go into the finance system, and if it's a $100,000 contract, they'll go to that line item, they'll take that $100,000, and they'll move it over here into the encumbrance column so that it can't be used for anything else. And if you do that always before you contract for something, you never will overspend your budget. It is absolutely impossible to overspend your budget if you use that system faithfully. An appropriation budget is enacted by an ordinance of council. When you enact it, there will be numbers that you will appropriate, specific numbers, and whatever level of detail you go into in that ordinance is considered to be the legal level of control. And per Ohio law, most governments, cities included, must appropriate at least 2 amounts per department. So let's say it's a police department. You have to appropriate an amount for personal services, salaries, wages, benefits, and an amount for everything else. So if you appropriate $500,000 for the personal services and $100,000 for everything else, that would be the amount in your ordinance. Now, there are plenty of line items under that. The salary accounts, the PERS account, the health insurance, the workers' comp, down in other expenditures, various supplies accounts, you name it, repair and maintenance. But in my mind, ideally, you would appropriate just at this very high level and leave the management of those individual line items to your staff. If you appropriate at a higher level, I mean, you could go down and say, I want to appropriate at the line item level. I'm going to appropriate every office supply account. And every time they need to make an adjustment to that, staff's going to have to come back to you, and you're going to be doing supplemental appropriation ordinances all the time, or you're going to be out of compliance with state law, because these amounts that you appropriate, if they're exceeded, that is a violation of law. So if during the year your finance staff determines that $100,000 for the other expenditures will be insufficient, they will come back to you with a recommendation for a supplemental appropriation ordinance. But they need to do that before they've spent the money, ideally. So again, I don't know where you are in your organization. I really favor this 2 amounts per department. There are a lot of different ways to do a budget. I won't get into much detail here. Just to say that a very typical governmental way of doing a budget is the last year's amount plus a percentage. Last year you had a $100,000 budget. We're increasing all the budgets 2%, so you have $102,000 this year. That model has 2 inherent flaws in it. There's based on false assumptions. One false assumption is that next year we're going to be doing the same things that we did last year. And maybe through that goal-setting process we talked about, you're not. The other false assumption in that is that last year's amounts were warranted to begin with. And so that if there are amounts, if there are budget errors, they're going to perpetuate year after year after year. So I do favor some sort of a zero-based budget, some sort of a building from the ground up. That really can be done. And a lot of this would be administered at your staff level. Again, I'm not advocating council get too much into line items but I do favor some sort of a zero base. I'll give you an example. Just in a water treatment plant, the chemicals. Well, the people out there, they know how many million gallons of water they're going to treat. They know the ratio between the chemicals and how much is needed per million gallons. They know what those chemicals cost. Do the math. You can build most budget items up from the ground floor and justify those that way. The one takeaway from this slide would be the second item in the list there, which says to build a budget upon conservative but likely scenarios of events. As an example, a repair and maintenance budget, if your scenario is everything's going to break, then you're going to over budget. And what you've done then is you have denied resources from some other worthy activity over here. And conservatism in budgeting is a good thing, but over-conservatism will restrict you from doing the things you need to do. So I have always tried to keep in mind that phrase, a conservative but likely scenario of events. We talked briefly a moment ago about supplemental appropriation ordinances, and I just mentioned in practice there's a couple ways these are done. Some cities, the staff just keeps a list of all the adjustments that need to be made, and one time at the end of the year in December they bring you an ordinance and you do all of the adjustments, budget adjustments at once. The other way of doing this is to come to you whenever those adjustments appear to be needed. It's done in different ways in different communities. My own personal preference is to do the adjustments as you know they're going to be needed. When I was a finance officer or finance director, I would generally bring 5 or 6 of those to council in a year's time because I wanted the budget to always reflect the latest and greatest, best information. But again, it's done the other way in some communities, and they work fine with it. And this is the certification that the fiscal officer has to make before placing any order or entering into any contract. And those are the 3 things that are on that certification. I'm a proponent of, if it's important, write it down. And every organization has policies. Every organization even if they haven't written them down, you have policies and you have financial policies. We've always done it this ways. And I'm a proponent of having a process to get those down onto paper so that it becomes part of who you are as an organization. And when you have turnover and new council people come in, those policies are there. And there's an understanding right away of how we govern ourselves, how we manage our finances. I'll just mention a couple of these. We've already touched on a couple things. The balanced budget. What is a balanced budget? It's nice to have that written down somewhere in a policy. The fund balance reserves, we talked about that earlier. In this example here, the $200,000. Again, a very, very, very important policy. Long-term financial planning. We're going to have a few slides on that at the end. And because I think an organization should be, a government should be committed to looking at things on a long-term horizon. On the revenue side, an important policy is use of one-time or temporary revenue. If you get a one-time revenue or something that's not going to last long, please don't hire staff with that. Because when the revenue goes away, you still have the staff. And so it's good to have in written policy form that when that occurs, we'll buy something, a capital item with that. Review of charges and fees. This is an interesting one to me. Many years ago, I received a database of information, and I think the database was collected in the late 80s, early 90s, and it was every municipal utility in the state of Ohio over a multi-year period. It was data about their rate increases. And at that time, the average municipal utility raised their rates every 4.5 years. And when they did, they raised those rates 22%. It's no wonder that municipal rate increases have been met with a lot of resistance over time. Now, we've been fortunate in later years, in recent years, and I think councils and cities have gotten better about this. I just don't see that stair-stepping pattern anymore. And we've also been blessed with lower inflation environments in the last few years. But nothing else that we buy behaves in that pattern, where it stays here for a long period of time and then shoots up, stays here for a long period of time and shoots up. And consumers are accustomed to things going up in a regular business-like pattern. And so I would encourage you to have a practice and perhaps a written policy that you will review your fees and charges, the major ones at least on an annual basis, some of the other ones perhaps a little less often, but that there will be a review done of those at the staff level, and they come back to you with their recommendations. And my recommendation would be, even if it's a small rate increase, a 1%, that you do it. Because customers understand that. They do understand that. And even if you get in a pattern of even those small increases, then they become accustomed to that pattern. So I think that's very, very, very important. It does not benefit you to put off those tough decisions. I assume you all have a multi-year capital improvement plan. Is that fair to say? 5 years, probably the common. Just a quick takeaway from this is if you have, for any capital item, consider what the operating costs are going to be and make sure you built that into next year's budget. Please don't build a new building and not put into the budget that you're going to have more insurance, more utilities, and the like. And I won't go into any depth at all on this, other than to say that if you don't have a debt policy as an organization, it's something to consider. The Ohio Revised Code's debt limits are very high, and I think in most cases, if you follow just those debt limits, you may end up borrowing more than you should have. And so it's good to have another one of those thoughtful reviews as to how much debt can our organization bear, and to establish those internal debt limits. I don't think that governments have traditionally done a good job at planning for the long term financially. The federal government, we can just start and end right there. A one-year budget is really not an effective process to make informed financial decisions. If we look at our example over here where we ended the year with $200,000, and if you look at that in isolation, you would say, that's great. We met our policy. We have some money in the bank. That's a great budget. But what if you knew that in year 3, the state's going to cut some revenue source? This happened years ago, a few years back, with the estate tax, which affected some communities to a great degree. What if you knew that was on the horizon? What if you suspected a major employer was going to be moving some operations out of your city, or were going to be decreasing operations? What if your capital plan called for building a new fire station a few years from now? You have to staff it. How would that change your decision in the next year's budget? Would you still feel so good? Would you still feel good about the $200,000? Probably not. Probably not. So I favor some sort of a multi-year forecast, a multi-year planning process, not just for the capital, but also on operating, at least your major funds where you employ most of the people in the organization. And this can help us to identify those challenges that are out on the horizon, to put a name to those challenges, to actually see where the lines start to cross in a negative way, where you identify the imbalances and you understand why those imbalances are going to occur. But the result of that, it would causes us now to develop strategies to achieve financial stability out on that horizon. It will help us not only to meet that target of where we want to be, not just next year, but what are the things that we need to be doing and doing now so that we meet this target in years 2, 3, 4, 5. If you knew that 5 years from now that you were going to need $800,000 more dollars for your general fund, you can wait till year 5, and in the average general fund that has police and fire, the majority of your budget's going to be police and fire, and probably 80% of your budget is going to be staff costs. You cannot make any major adjustments to your budget without affecting safety staff. And so that $800,000 5 years from now might look like 10 safety personnel, 10 positions. But if you're looking out over the horizon and you start tacking that now, maybe you can do something like say, hey, we have a couple retirements that are getting ready to occur. We just mothball those positions. And those 2 positions over 5 years, I'm oversimplifying some, but those 2 positions over 5 years are going to get you the same place in year 5 at least as waiting to the end and cutting away 10 positions. So that long-term multiplicative value of making those decisions now is so important. At least 3 years, 5 years is where I prefer. I suggest doing that sort of a long-term look before the annual budget. That be a process added on the front end. I will show you a document here. As Star mentioned, I spent a lot of time in the city of Sydney, and we very much formalized that 5-year plan process. It's a pretty big document. And I think it helped us to weather some very, very tough storms. And in the early 2000s, we had some difficult times, and particularly in 08 and 09, we had some very, very difficult times. We lost over 25% of our income tax revenue in a 2-year period of time. And yet we were able to get through that without layoffs and without major disruption in services. And I credit this long-term thinking, this big picture thinking. I recall the first time in a council meeting after we had made a big commitment to this, the first time that a council member said, hey, that'd be great if we did that, but how does it affect the 5-year plan? And I felt like a proud papa. That was fun because it told me that now the organization has incorporated this into their way of thinking. So whether you formalize it like this or whether it's something less formal, I'm just encouraging you to be thinking long-term, over the horizon. One of the things that, when this is presented to staff, and this presentation was originally for staff members, we say one of the biggest challenges is elected officials buy-in, so that's why I wanted to bring that to you today. Quickly, an audit. State of Ohio, the auditor's office is in charge of the audits. They're going to come out, and the auditor staff is going to do your audit unless you are fortunate enough to have them allow you to go out and contract with a private independent auditing firm. And in that case, it's a 3-way contract between the auditor state, your city, and the auditing firm. The audits have to be completed within 6 months of the year end. You're going to get the opinion letter, which says your financial statements are in conformance with GAAP. And you also may see a management letter, which is just some suggestions on what could be done to improve some things. Please don't get too shook up about management letters, as long as your staff is addressing those things over time. Management letters are just suggestions. All right, last thing. There's 3 bond rating agencies, Moody's, Standard & Poor's, and Fitch. And over time, they have come to be more and more interested in what your financial policies and practices are. In Sydney, we received an upgrade from an A2 by Moody's, went up to a AA by Standard & Poor's. And we did it in a time when financially the economy was not very good. But what they pointed to, they said you have financial policies and practices that are solid, that they're ingrained in the organization and they're repeatable, and we're comfortable that you're doing the right things. And I don't know, if you go out to the bond market, that rating is so important. It will save your community hundreds of thousands of dollars. But Fitch put together a list of management practices they like to see, and we've talked about some of those today. We talked about multiple year finance forecasting. We talked about the fund balance reserve policy. We talked about the non-recurring revenue policy, debt affordability. We briefly touched on the fact that you need a debt policy. These are things that one of the bond rating agencies has said, if you do these things, you are a well-managed financial operation. Your government is doing well. Again, if you go to the bond market, it will save you a lot of money, but I just think these are good practices whether you're in the bond market or not. So that was a lot of information, and I hope there are some takeaways there. Thank you.
Thank you, Tom. That is one of the hardest tasks, is to try to present information on budgeting and finance in 45 minutes. Today, we're just kind of giving you a flavor for some of the things. We're providing you some detail, but we're not able to get into the real long nitty-gritty part of some of this stuff. And so I want to encourage you that if you feel that, hey, I'd like to learn more about finance, government relations, for instance, our next topic on ethics, there are some of these trainings that are going to be provided to you or made you aware of, such as ethic training, or later on this afternoon, we're going to be talking about the Sunshine Law in regards to communications. We're kind of doing what today in 45 minutes, what we could easily do, as Tom said, in 3 hours or more. So please let us know, let your city manager know that you're interested in this training. And if you feel like you want more and there's not an upcoming training already scheduled on these topics, we'll be glad to put that together, because again, that's what we do. We put together things to help you all do your job. So please take advantage of that and take advantage of what we can do for you.